The barrier has fallen. For 45 years, ever since the Hunt brothers were crushed in 1980, the global banking cartel drew a line in the sand. They defended it with paper contracts. They defended it with margin hikes. They defended it with coordinated media blackouts. But look at what is happening right now. It is moving faster than anyone predicted. They told you $30 was the ceiling. They told you $50 was impossible. On Monday, we broke $59. Yesterday, we took out the Maginot Line at $60. And today, Thursday, December 11th, 2025, silver didn't just hold the line. It smashed through $63. As I speak to you, silver is trading above $63. We are watching the real-time vaporization of billions of dollars in naked short positions. The move is accelerating. It's going vertical. Silver isn't just trading above $60. It is trading in a vacuum. The Maginot Line, the fortifications built by JP Morgan and the bullion banks to suppress the true price of reality, has been overrun. But here is the terrifying part that the mainstream media is too afraid to tell you. They are telling you this is a speculative bubble. They are telling you to take profits because the charts look overextended. They are lying. What we are seeing is not a bubble. It is an autopsy. It is the mathematical inevitability of a 1.1 billion ounce hole that the world ignored for 5 years. The price you see on the screen, $63, isn't expensive. It is the floor. Stay with me. In the next 20 minutes, I am going to open the books on the greatest transfer of wealth in human history. I am going to show you why the ghost inventory that kept silver cheap has ceased to exist. I will prove to you why there is zero technical resistance between here and $100. I'm going to reveal the specific commercial signal failure that proves the banks have lost control of the algorithm. And most importantly, I'm going to answer the question that keeps the bankers awake at night. Where did the 1.1 billion ounces go? Hint, it didn't vanish. It moved. It moved from the west to the east, from the paper believers to the physical realists. And if you are not holding metal when this video ends, you are standing in a burning building hoping the fire insurance company is solvent. The default has begun. Let's look at the body. To understand the violence of this move, you have to understand what $60 represented. In military history, the Maginot Line was a series of fortifications built by France to stop Germany. It was supposed to be impenetrable. For the bullion banks, JP Morgan, Citi, and specifically the elephant in the room, Bank of America, $60 was their Maginot Line. Why? Because above $60, the math of the derivatives market doesn't just bend, it breaks. You see, for decades, the banks didn't sell silver. They sold contracts. They sold promises. The standard COMEX contract represents 5,000 ounces. Whenever silver got too feisty, whenever it threatened to reveal the currency devaluation, the banks would flood the market with these paper promises. They would print silver out of thin air, trigger the stops, scare the retail investors, and wash, rinse, repeat. It was a money printing machine. But this strategy relies on one critical assumption, that there is enough physical metal in the vaults to create the illusion of supply. Something changed in the last 2 weeks. Traders, I need you to listen closely to this. We just witnessed a commercial signal failure. For 40 years, the pattern was predictable. Price rises, banks increase shorts. Price crashes, banks cover. But as silver rallied from $55 to $60 and then punched through to $61.75, the banks did not add more shorts. In fact, open interest declined. Do you understand the gravity of that signal? It means they stopped fighting. It means the algorithm that managed the price has been turned off. Why? Because of the Basel III net stable funding ratio. We warned you about this years ago. The new regulations make it prohibitively expensive for banks to hold unallocated paper liabilities without physical backing. The compliance departments at these massive institutions tapped the traders on the shoulder and said, "Game over. Get out. We cannot afford the capital charge because the physical metal isn't there." So, the banks are no longer the manipulators pushing the price down. They are now forced buyers trying to exit a burning building before the roof collapses. They are bidding against themselves. They are bidding against the hedge funds. They are bidding against the industrial users. And this is why $61.75 is not the top. It is the starting gun. When the manipulator becomes the buyer, there is no ceiling. The rope that held the balloon down has snapped. But why now? Why December 2025? To understand the timing, we have to go back to the scene of the crime. We have to talk about the 1.1 billion ounces that the world consumed but never replaced. Let's strip away the noise and look at the raw arithmetic. The media wants you to focus on the daily price action. I want you to focus on the geological reality. For most of the 2010s, the silver market was in a surplus. Miners dug it up, industries used it, and there was leftovers. That leftover silver, the ghost inventory, sat in vaults in London, LBMA, and New York, COMEX. It was the buffer. It was the slush fund. It allowed the world to feel comfortable. Then came 2021, the year the world changed. I have run the numbers. I have tracked the deficits from the Silver Institute. I have tracked the drain from the LBMA. The math is not just bad, it is terrifying. In 2021, the deficit started. In 2022, the Silver Institute reported a deficit of 237.7 million ounces. In 2023, another 140 million. In 2024, it widened to 215.3 million. And now, closing the books on 2025, projections show we burned another 200 million. Add that up. That is nearly 800 million ounces of structural deficit. But wait, that is just the reported deficit. That doesn't account for the investment drain. The silver pulled out of ETFs like SLV and moved into private, unallocated storage where the banks can't touch it. When you add the drain from the LBMA vaults, which have plummeted 30% from their peak, and the retail stacking frenzy, the real number is over 1.1 billion ounces. Let that number sink in. 1.1 billion. The entire global mining industry produces about 830 million ounces a year. That means for the last 5 years, we have been short more than an entire year's worth of total global production. We have erased the output of every mine in Mexico, Peru, China, and Russia combined for a full year. Where did the extra silver come from to feed the factories? It came from the ghost inventory. We have been cannibalizing our savings account to pay our daily bills. We have been eating the seed corn. And the banking cartel loved it. As long as there was ghost silver to bleed into the market, they could point to the vaults and say, "See? Plenty of metal. No shortage here. Go back to sleep." But math is undefeated. You cannot run a deficit forever. Eventually, the savings account hits zero. That is what happened this week. That is why we broke $59. The ghost silver is gone. The LBMA float, the metal actually available for lease, is effectively zero. The COMEX registered inventory is running on fumes. Now, every new solar panel, every new cruise missile, every new iPhone has to be built with silver that was mined yesterday. There is no buffer. There is no slush fund. The 1.1 billion ounces didn't just vanish into thin air. They were burned up in industrial processes, buried in landfills, or locked in private vaults that will never see the light of day at these prices. The anchor is gone, and we are entering a vacuum. Now, the skeptics, the people who have been wrong for 5 years, will tell you, if silver hits $60 or $80, demand will crash. Industries will substitute. They will use copper. This is the single biggest lie on Wall Street right now, and I am going to destroy it with one acronym, TOPCon. For years, the solar industry used a technology called PERC. It was fine. It was efficient enough. But PERC hit a wall. In the energy game, efficiency is everything. If you can get 1% more power out of a panel, you win the contract. So, in 2023 and 2024, the entire global manufacturing base shifted to TOPCon, tunnel oxide passivated contact, and HJT, heterojunction, cells. Here is the problem for the bears. TOPCon doesn't use less silver. It uses more. PERC used about 10 milligrams per watt. TOPCon uses 13. HJT uses 22. We are moving toward more silver, not away from it. Why can't they switch to copper? They tried. Oh, how they tried. But copper oxidizes. It corrodes. It kills the lifespan of the panel. When you are selling a solar farm to a pension fund with a 25-year warranty, you cannot use a metal that rusts in 5 years. You need the noble metal. You need silver. And here is the economics of the solar vortex. This is the concept of inelastic demand. Let's say a solar panel costs $200 to manufacture. At $25 silver, the silver inside cost about $15. That's 7.5% of the cost. Now, look at today. Silver is roughly $60. That silver now costs $35. Does the manufacturer stop making the panel? No. Does the government cancel the green energy mandate? No. They just raised the price of the panel from $200 to $220. A 100% increase in the price of silver only increases the cost of the final product by 10%. This gives silver pricing power that almost no other commodity has. If oil doubles, you drive less. Demand destruction. If silver doubles, Samsung, First Solar, and Tesla keep buying. They have no choice. In 2024 alone, solar consumed over 230 million ounces. By 2030, the University of New South Wales projects solar could consume 85% to 98% of global silver reserves. Not annual production, reserves. The silver's still in the ground. We are strip mining the planet to go green. And we have run out of the easy metal. So when you see silver at $61.75, don't think expensive. Think necessary. The industrial buyers aren't looking at the price chart. They are looking at their production schedules. They are terrified. They are the ones buying right now. They aren't buying paper contracts on the COMEX. They are calling refineries directly and saying, "We will take everything you have. Name your price." That is why the spot price is leading the futures price. The physical market is screaming. But there is one player who saw this coming before anyone else. One player who drained the West dry. If you want to know who won this game, don't look at Wall Street. Look at India. While Western investors were dumping their silver ETFs in 2023, while you were being told silver was a dead rock, India was doing something unprecedented. They were draining the West. Look at February 2024. Mark that date on your calendar. That was the beginning of the end for the London vaults. In that single month, India imported 2,295 metric tons of silver. Let me put that in perspective for you. 2,295 tons is roughly 73 million ounces. The United States Mint produces about 20 million silver eagles a year. India bought 3.5 years of total U.S. mint production in 28 days. Why? Because the Indian whales, the smart money in the East, saw the deficit coming. They saw the 1.1 billion ounce hole before we did. They knew the solar factories being built in Gujarat would need massive amounts of paste. They knew the Gift City Exchange was opening to challenge the West. So they bought the bottom. They bought when silver was $22. They bought when it was $24. They cleaned out the London vaults while the LBMA was asleep at the wheel. And now? Now that silver is $60? You might think, oh, India will sell. They'll take profits. No, because in India, silver isn't a trade. It is wealth. It is the poor man's gold, but it is also the rich man's strategic industrial input. The silver that went into India isn't coming back. It has been turned into anklets, or it has been consumed in electronics factories. It has left the free float. This is the key to the narrative. The silver didn't just vanish. It moved from weak hands to strong hands. The West is now waking up to a shortage, realizing they sold their insurance policy to the East for pennies on the dollar. JP Morgan knows this. They track the flows. Why do you think the tamp downs stopped working? Why do you think the price crashes stopped sticking? Because you can't spoof a market that has no metal. You can't flash crash the price when India is standing there with a bucket, ready to buy every single dip. The Indian whale broke the back of the short sellers. And now, the West has to pay the price to get any metal back. So here we are. December 2025. The price is $61.75. The buffer is gone. The ghost inventory is zero. What happens next? We enter the vacuum. In technical analysis, resistance is created by people waiting to sell. If you bought at $30 5 years ago, maybe you sell at $30 to break even. That creates resistance. But who bought silver at $65? Who bought silver at $75? Who bought at $85? Nobody. There is no overhead supply. There are no bag holders waiting to get out. This means that, technically, the sky is clear. This is what we call a blue sky breakout. When an asset clears its all-time highs, it enters a phase where the only way to find a seller is to bid the price up. We saw this with Bitcoin when it broke $20,000. It went to $60,000 in months. We saw this with Nvidia. Now, it is silver's turn. But there is another target. A target that the 1.1 billion ounce deficit points to directly, $100. Why $100? Is it just a round number? No. If you adjust the 1980 high of $50 for inflation, even using the government's own rigged CPI numbers, That $50 is worth roughly $170 today. So at $61, silver is still historically cheap. It is still 60% below its real all-time high. But the vacuum effect works like a feedback loop from hell for the banks. 1. Shorts cover. The hedge funds must buy to survive. 2. FOMO. The retail public, seeing $60 on the news, rushes in. 3. Industry panic. This is the big one. When Tesla and Samsung realize the buffer is gone, they stop buying just in time. They start buying just in case. They hoard. Hoarding creates scarcity. Scarcity creates higher prices. Higher prices create more hoarding. The 1.1 billion ounce deficit wasn't an accident. It was a transfer of wealth. It was a transfer from the impatient to the patient. From the paper believers to the physical realists. From the West to the East. For 5 years, the data was screaming. The Silver Institute reports were public. The LBMA vault data was public. The India import numbers were public. Everyone had the chance to see the whole forming. Everyone had the chance to buy silver at $22. But they listened to the TV. They listened to the banks. Now, the Maginot Line is broken. The vacuum is pulling us higher. I believe we will see a rapid move from $61 to $75 before the end of the year. And $100 is not a 2030 target. It is a 2026 target. If you are watching this and you still hold paper, unallocated accounts, SLV, or pool allocated schemes, listen to me. You are standing in a burning building. Get the metal, if you can still find it. Because the 1.1 billion ounces that vanished are never coming back. And the next billion ounces? They're going to cost a hell of a lot more than $60. The squeeze isn't coming. The squeeze is here. The default is in progress. I'll see you at $100.